Today we're going to go into case study 1. I find that case studies are the core of this class. Case studies are looking at hedges that corporations have used that have done very well and hedges that corporations have used that have blown up. So my goal in this course is to show you how companies hedge, why hedges did work and why hedges did not work, and maybe what they could have done to prevent companies from losing, in some cases, billions of dollars, and actually in some cases destroying a company because of improper hedges. So really that's the core of the class. So case study 1 is the simplest hedge, and even the simplest hedge gets a little complicated. But we're going to go into one of the largest hedges in the world, and it's actually done by the Mexican government. And so this is actually called the Hacienda Hedge. And why is it called a Hacienda Hedge? Is because the Secretary of Hacienda Providence in Mexico, their group sort of was in charge of putting together this hedge. Now what's interesting is the country of Mexico, 1/3 of the government's revenues is from their oil. They've nationalized their oil. In other words, the oil is not a private company like ExxonMobil is a private company. The oil industry is a government agency. 1/3 of the Mexican government gets their revenues from oil. They drill oil, they produce oil, and they sell oil to the world. So you can understand that if the revenues of a country, if the revenues of a country are coming from the price of oil, they need to make sure that it's not $10 a barrel. And if it's $150 a barrel, the government's doing very well, the government's got a surplus. But if it's $10 a barrel, then they're not doing so well, and the government can go bankrupt. So what essentially a hedge does is it removes from the balance sheet a variable cost and turns it into a fixed cost. And that's the whole idea of hedging, is to protect the price of the commodity, whether you're a producer of a commodity, and we call that upstream. It's coming, you're upstream. That means you're taking, in this case, oil out of the ground. And if you're buying oil, let's say you're a utility company, that's called downstream. But anyway, we'll get into that later in the class. So today we're going to do a short video on case study 1 called the Hacienda Hedge. And there's been several articles written about the Hacienda Hedge. There was a very nice piece in Bloomberg, and there's also a nice article in the Financial Times, which is where I was able to vet this hedge. A lot of companies don't like to talk about their hedges for a lot of reasons, because they don't want other traders to front run their hedge, which would make the hedge more expensive. Get into that in more detail later in the class. And the other reason is that companies where their hedges blow up, they don't really want to talk about. And of course, if it's a public company, they have to disclose that in their financial statements. So a lot of times we can find out what went wrong with the hedge if it's a public company by looking into the docs they send to the Securities and Exchange Commission. So let's get into the largest hedge in the world, the Hacienda Hedge. And I did put into Canva the article uncovering the secret of Wall Street's largest oil trade. So I'm going to want you to read that, but I'm going to give you a quick overview of this hedge, the scale and nature of the hedge. If you've been to Mexico, if you've gone on vacation in Mexico, you see the state energy company Pemex, and you see the signs and the gas stations, and how they engage in the largest scale oil hedge. It involves buying a simple put. Now, a put is an option, and think about a put as a simple insurance contract. So we all have insurance on our car through State Farm or Travelers or whomever, and we buy that insurance. That's exactly what a put is. It's you're buying insurance. It gives you essentially the right, but not the obligation, that if you get in a car accident, you can call the insurance company and say, hey, I need to, I have a claim, and of course, maybe you have a deductible. But every quarter, every year, you pay a premium. You pay so much. And that premium is based on how volatile your driving is. So if you're a very volatile driver, your premiums are higher. And if you're a very good driver, your premiums are lower. The same thing with oil. If the oil patch tends to be a very volatile, and which it is, then the premium on these insurance contracts aren't cheap. They're expensive. And so, but they're essentially covering hundreds of millions of barrels. So they're buying huge, huge amounts. What Mexico has done very well is they've been able to buy this insurance at the right time. So they were aggressive, and they've hedged oil when it was very high. In this case, $150, $147 a barrel. So when oil crashed, they were locked in and protected at $147. So they weren't, during COVID, oil had dropped down to $12 a barrel. So they didn't experience that because of this insurance. From a financial hedging point of view, Mexican federal budget, the cost is again based on the volatility of the oil. Given that oil revenues constitute a significant portion of the Mexicans' national income, as I said, they're nationalizing the oil, the hedge serves as a form of insurance, stabilizing the revenue stream and reducing borrowing costs for the country. Now, it is complex because if you remember in 2008, or you may have read, a lot of the students in this class, 2008 was a little while ago. It's 2024. So, yes, anyway, if you've read that a lot of banks were going to collapse, a lot of them did collapse, Lehman Brothers. A lot of them were bailed out by the government, and a lot of public companies were actually taken over by the government. One of the largest insurance companies in the world, AIG, was actually, the government had to take it over. They essentially sold it back or took it public again, but they had to, because AIG insured essentially half the globe, so there was no choice. But anyway, it's very complex. How they do it, what type of options do they do it? We'll get into that in a little bit. But essentially, an option is an insurance policy. If I buy a put, I'm buying an insurance policy. The Mexican government and its banking partners maintain a high level of secrecy because, again, if the Mexican government is buying insurance and other traders around the world know when they're buying insurance, they can actually bid up the price of that insurance. Okay, that's interesting. So they don't really want people to know when they're buying insurance. And that's an interesting part of it. Other major oil producers naturally have not replicated this hedge, which is interesting because the Mexican hedge has actually done very well, and it has outperformed many, many other companies' hedges. And you're talking about publicly traded U.S. companies and European companies that got decimated by these sharp kids from Wharton or Booth or New York, NYU, that have put on these hedges and absolutely destroyed the company's dividends or stock price. So a simple insurance policy, a simple protective put, has actually done very well. It's like cooking. Sometimes the best food is the simplest, not complex, not a lot of spices and flavors. I'm digressing, but sometimes the simplest is the best. And in this case, the Mexican hedge has actually done very well over the years, and it's just a simple protective put. We will get into the 8-week semester, a lot of the major hedges, and this is the simplest, just a protective put. But this is an option. We're going to get into swaps. We're going to get into different types of option contracts. We're going to get, of course, into futures, the good, bad, the ugly. All different hedges have benefits and advantages. And so what hedge do we use? When do we use it? How do we think about how it can blow up? That's what we're going to try to learn in this semester. We call it 8 weeks a semester. In summary, the Hacienda hedge is sophisticated, but it's less sophisticated than a lot of the hedges. I'll get into this in this 8-week class. And that's interesting. It is actually sophisticated, but the simplest of all the hedges. So let's kind of jump into it. There was an article in the Financial Times, one of my favorite papers. I read the Financial Times every day, and if you're not reading the Financial Times, it's a paper you want to subscribe to. Not the Wall Street Journal, not the New York Times, not to some of these rags around the country, the globe. I find the Financial Times to be very objective and very good. I think Bloomberg is also another good source of news if you get a subscription to Bloomberg. But anyway, there was an article in the Financial Times, and I thought we would start there. It talks about how the hedge was put together. And it, as I said earlier, this particular 1/3 of the federal revenues come from Mexico's drilling of oil and selling it to the globe. And I think that's interesting. The federal government undertook the program during perilous times. Began back in 2003. The price of barrel was $103. And a group of government officials got together and said, hey, how do we put together a hedge that's going to protect the price of oil if it should drop? And they kept it simple. The problem with if there's a negative about just a protective put, the negative is that it's a hard cost. There's a hard cost. It's not a zero cost hedge, which a lot of companies always are looking to do. It's saying, how do we hedge and not pay for it? And we'll get into that. But anyway, when you put on and you buy a protective put, there's a hard premium cost. And that premium cost, as I said, is going to really be determined by how volatile oil is at any particular time that you buy it. If oil has been very flat, there's not a lot of volatility, the premium, the price of insurance goes down. If oil is extremely volatile, the price of insurance goes up. And a lot of banks won't put on hedges and will not participate, as you read the Bloomberg article, because they're afraid that their liability is too great. Now, insurance companies try to hedge off. When they sell insurance, I'm going to get into, they try to hedge off their risk. Insurance companies don't particularly want to be in the business of getting slapped with a huge payout. Think about the hurricanes in Florida. Think about if you live in Colorado, the fires in Louisville. The amount of money the insurance companies paid out was in the billions. So number one, how does an insurance company sort of defray the liability? And they need to charge enough premium to where if there is a claim, they're covered. So again, a protective put is just a straight insurance policy. Now, when you buy a protective put, it's an insurance. It's no different than if you buy insurance on your home. In this particular example, they're talking about how Mexico bought insurance at $76.40 a barrel, and oil was trading at $85. Well, what they are doing is they're saying we're willing to take a loss on this particular contract down to $76.40, and the reason they're doing that is because they're saying the cost of the hedge is cheaper. It's like a deductible. Example is my auto. I get in a car accident, I have $1,000 deductible. So if it's $6,000 to fix my car, well, I've got to pay $1,000, and then the insurance covers the next $5,000. No different here with the in this particular case. They're saying, okay, we want to protect our price at $76.40, and right now oil's at $85, so we're not protecting it from its current price. And then it talks about how if oil goes up, the premium that is paid out evaporates. There's no benefit to Mexico. And there's a benefit to the bank because the bank gets to keep that premium. Just like if you never get in a car accident, think about that. If you never get in a car accident and you pay car insurance for 30 years, insurance company's loving you. Now, the insurance company over time might say, hey, we looked at your driving record and you know what? You're a very safe driver. we're going to reduce the cost of your insurance, which you don't see that much anymore because insurance companies are in the business of making money. In fact, what's really interesting is if you look at the biggest buildings around the United States and cities, I mean, you go to Dallas or New York or Chicago, the biggest buildings are insurance companies. They make a lot of money. There's no coincidence that Warren Buffett owns Geico. He's not stupid. In fact, he's the oracle, right? So Warren Buffett knows that insurance is very, very profitable. Of course, insurance companies have gone out of business and have lost money because they're not defraying or hedging off their risk or not collecting enough premium, which was the case in 2008. All these insurance companies were selling these CDOs, these collateralized debt obligations, which is basically a protective put, because they thought never in the history of the housing market has there been a systematic crash. Because remember, they're securitizing these loans, they're wrapping up these loans in thousands of mortgages. So what's your chances of all these mortgages defaulting in a large amount? We're diversifying those mortgages. Well, we all know what happened, and that's why a lot of the banks, it almost crashed the global system if the U.S. government didn't come in and write some big checks. So again, that's an interesting parable, but essentially a protective put is an insurance policy. They started the program in 2003. This year by new derivative rules. There was a rule in this article talks about a new rule that said the SEC said you need to disclose your derivatives trades, report them. And of course, that's not a great thing because you sort of showing your hand in cards, right? And so you have traders that will front run that trade. The Mexican government does not want you to know when they're buying these contracts because traders are able to quickly discern, and then they could bid up the price of the insurance. And in this case, as I said, 76 was the strike in this particular year in 2014. But the government sets aside 7.94 billion pesos, or 543 million, to cover the difference. The difference in the price between 76.40 strike and the price of the option, and 79 the price of the 2015 budget. So they're not protecting the price from where it is today. They're saying that we're willing to let it drop a bit. We'll have a deductible on that insurance. And that's kind of the concept. So let's kind of get into a long put. As I said, it's an insurance contract. And every long put has a premium cost. And that premium cost is going to fluctuate based on how volatile the actual asset is, or this commodity. It's just an insurance policy. When you buy it, you have the right and not the obligation. What that means is if you get in a car accident and you decide, I'm not going to call my insurance company because I don't want my premiums to go up. I live in the mountains, and quite frankly, I've had a lot of claims, and I've been dropped, 3 or 4 times. My insurance agent called me up about a year ago and said, your premiums are jumping up to $26,000 a year. Well, I almost had a heart attack. My insurance premium, just to insure my home. Well, luckily, my neighbor got me into found me an agent that was able to insure it at $10,000. Well, if I have a hail damage, if I have a flood, I will not be taking that claim because I don't have the obligation when I'm long insurance. But when I'm selling insurance, when I'm the insurance company, of course, if I call up and say, hey, I have a flood in my home, they're obligated. So one thing you have to understand about options and about being long insurance, that means a trader is short insurance, or the insurance company that's selling is obligated. And that's a simple fact of options. Options on, of course, stock, which has become very popular, but options on commodities, the same kind of thing. Now, options on commodities are interesting, and in this particular case, if we're looking at oil, Brent crude, or WTI, West Texas Intermediate crude, you're looking at a situation where one put option equals one futures contract. So in other words, A put option represents one futures contract. And a futures contract equals 1,000 barrels. So if I'm drilling 10,000 barrels a week and I want to protect that price, I would buy 10 puts to do that. Now, you may not buy weekly puts. You may say, well, what am I drilling over a month or a quarter? So I'll add all that up and I'll buy quarterly options, or I'll buy options that expire every 6 months. In Mexico's case, they tend to ladder it out. What they call, they roll and they stack it. So the bottom line is that they may have options expiring 6 months, 1 year, so on and so forth. And there's advantages to how long insurance you buy. Is it better to buy short term? Is it better to buy long term? There is a relationship between longer dated options on a relative basis cheaper than shorter dated options. So you want to buy long and sell short, but again, later in the semester. So you can see that you have a premium cost. And of course, if the options expire and you never use the insurance, you lose the premium. If the market should crash, oil should drop, you could do very well. And the premium is covered by what the insurance policy pays out. Okay, it's just that simple. Now, this last slide is just what I want to show you. I had my techs, my quants, run a regression of looking at a long put every quarter. I was assuming that, let's assume that an oil company decides that they're going to buy options that expire every quarter, because let's say they're delivering oil to their end users every quarter. So in this case, every March, June, and March into June, so on and so forth. So the point being is, okay, let me buy options that I am going to unwind at the end of every quarter. So what we did was we said, okay, let's do this. Let's look at buying protective puts. In this particular case, we're going to buy a 4-month put and we're going to close it 3 months. We're going to buy, and then we're going to roll that, buy a 4-month put and close it in 3 months. There's a basic rule when you're hedging on commodities. You always want the commodity to be longer dated than when you're going to close the contract. And again, later in the 8-week course, for this short video, don't want to get too deep into it. There's a lot involved, but what I'm showing here is how a protective put did against spot, and spot is in black. And then I have the red is actually a proprietary hedge that the firm that I run, IPS Strategic Capital, my proprietary hedge that I've consulted commodity companies with. And that is later, at the very end of the 8-week course, we'll get into some proprietary hedges that we as a firm have built and my quants have built. But you can see that what's nice about the protective put and comparing it to the blue line to the black line, you can see how just buying a protective put every quarter, or rolling it every quarter, buying 4 months, rolling it every 3 months, you can see how it actually, from 2006 to 2020, would have done much better than just not hedging at all. Now, let me just say that most commodity companies that either buy downstream or produce upstream don't hedge, which is interesting. Or they hedge and then get blown up, then they don't hedge. Then they hedge, they do well. So it's kind of a little crazy where if you look at the statistics, which we'll get into in later videos, why would you hedge then don't hedge? Well, if you hedge and you get blown up and you lose billions, the C-suite, the corporate execs say, well, let's not do that again. That was stupid. And then, of course, the price of their commodity gets crushed and they go, oh, we should have hedged. So there's a lot of, I don't want to say ignorance. I mean, these are really smart people that do this for a living. But I kind of scratch my head. I scratch my head that why so few companies hedge. The next thing I do want to mention is a lot of companies will partially hedge. And we'll get later into the semester some of my favorite incremental hedging strategies. We're saying, well, if I'm producing 100,000 barrels a quarter, let's hedge a third of it. This way, I'm in a situation where if prices do drop, at least I got 1/3 of my position is protected, and the other 2/3 may not be protected. So there's partial hedging, and that's pretty popular. But you can see this is the Hacienda Hedge. The students need you guys to read the articles, and then there's some quiz questions, or I think there's 5 homework questions on this. So thank you for listening to the initial case study 1, and we'll continue with the case studies throughout the 8-week course. Thank you very much.